Today I'll talk about the 10 things to look out for when buying a whole life insurance policy and you're buying it for the cash value. The first thing to look out for is if you see zero in cash value in the first year. Kind of a no-brainer, right? The thing is, this type of whole life insurance policy where you have zero of whatever you pay into the policy in cash value in the first year, and it takes between 10 to 15 years just to get your money back. I'll explain what that means in a minute, but this type of policy is the most common type of whole life insurance product that is sold in the industry. It has been for a long time, and I think it will continue to be the most common type of whole life insurance product sold because it is by far the most profitable type of whole life insurance policy sale. When you look at the stats, a little bit more than 90% of whole life insurance products sold are sold in this manner. So what this means is if you look at a life insurance illustration, you see a premium. Let's pretend you're paying $10,000 per year. Your first year cash value is zero. Your second year cash value is zero or very close to that. By the third year, you finally get some of your money back. But as you keep paying that premium year in and year out, you don't actually break even, meaning you don't get all of your money back until somewhere between 10 and 15 years. That's a long time. Then you start to see a return on your cash value. So where people often get upset with whole life insurance is that they are sold on the cash value benefits. They're told they're going to have all of this money long term, but then they look at it and say, it's like 10 to 15 years of my life, I'm just running a loss. There are so many other things I could do with that money. So the first thing I would look out for is the most common type of whole life insurance product that is sold, which the clear identifier here is if you see zero in cash value in the first year, it means that it is a traditional whole life insurance policy. It's a prime example of exactly what not to do. The second thing to look out for is a slightly better version of this. It could be the same whole life insurance product where I pay the same $10,000, but instead of zero, I see somewhere between 30 and 70% of what I paid available in first year cash value. So for example, I pay $10,000 per year, and in the first year, I might have 50%, call it $5,000 available in cash value. That's a 50% loss. Then as I continue to pay that $10,000 year in and year out, I see a return after 7 to 10 years. So it still takes a very long time to get my money back. This is something that I see a lot in the infinite banking and bank on yourself world. What that is, if you're not familiar with infinite banking, it's a concept that revolves around a dividend paying whole life insurance policy, and it specifically involves borrowing against the cash value of your whole life insurance policy. Why people are interested in it is because when I look at a whole life insurance policy, if my cash value is going to grow somewhere between 4 and 5% per year, if I take a loan against my cash value, I still get that 4 to 5% on the entire cash value, meaning the compounding is not interrupted when I borrow against the policy. So what a lot of people do is they put cash into these policies, it earns a return, then they borrow against that policy to go and invest in their business, real estate, whatever it might be. So sounds great, but where the problem lies is if I'm going to take this big hit up front, call it a 50% loss or whatever it might be, and it takes 7 to 10 years to get my money back, that's a huge lost opportunity cost, which there are other things I could do with my money. So what I would look for when I'm first looking at a life insurance illustration, in the first year, I would look for somewhere between 80 and 90% of whatever I pay into the policy to be available in cash value. The second thing I would look for is that my break-even point, which is when I get all of my money back and I start to see a return on my total payments, should fall somewhere between the third and fifth year of a policy. If I'm older, and maybe I have some health issues, it might be around the sixth year. But typically, it should be somewhere between 3 and 5 years. First year, 80 to 90%, break-even point between 3 and 5 years. If I see that, that is an indicator that the policy is set up for high cash value from the start. Now, That's the least common type of whole life insurance product that is sold. And here's why, which leads me to the third thing to look out for when getting a whole life insurance policy. Agents, meaning people like me, licensed life insurance agents and advisors, are incentivized to sell products with insurance companies and designs that do not prioritize the cash value. So for example, if you are paying $10,000 per year into a whole life insurance policy, and we go back to option 1, where you have 0 in cash value in the first year, my commission in the first year might be around $10,000. With large, reputable companies like the 4 major mutuals, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, it would be less than $10,000. With some smaller companies, it could be a lot more than $10,000. It could be as high as 130 or 140%, which is ridiculous in my opinion. But if you have 0 in cash value in the first year, I would make the highest commission. If you have 50% cash value in the first year, what do you think I'd make in commission? About $5,000. If you have 90% of your payment in cash value in the first year, what do you think I'd make in commission? About $1,000. See how it works? The more cash value a policy has, especially upfront, the first year is the thing to look at here, the less commission the agent will make. More cash value for you means less commission for the agent. That does mean there's a conflict of interest in this industry. If you are getting a whole life insurance policy and you say, I'm getting this for the cash value, it's very important to know what to look for and work with someone who is not going to be incentivized to sell you a product that might look okay, but is not maximized for your benefit. Now, one thing I want to hit on here is sometimes people do ask, how do agents make this work? If you are going to minimize your commission as an agent, how do you stay in business? The answer is really volume and the quality of business. I can use my business as an example. Over the years, we've grown. We've got more than 3,000 clients. All of our clients' whole life insurance policies are set up to have as much cash value as possible, and we always will use companies and products that tend to pay the lowest commissions. Now, the reason why we do that actually has nothing to do with the commissions or the commission rates. It simply has to do with the fact that I know designing the products in those ways with certain companies have always produced the most cash value for consumers. And if you do the right thing, the money will come. So with the life insurance policy, for the agent, there is what is called a renewal commission. As a client continues to make that payment, aside from the first year, there's a small renewal commission that is paid every year. It's typically paid through the 10th year with most companies and products. So if you have a lot of clients that are happy with their policies and continue to pay those premiums, your residual trail or renewal trail gets bigger and bigger over time. See what happens? Makes it much, much easier. The other benefit is that people are happy with their policies, the reputation of the business continues to improve, and I don't lose sleep at night worrying about a client who's going to go to a competitor and say, hey, I was sold this policy, the cash value is not that attractive up front, and then they can badmouth me and easily replace the business. I don't have to worry about that at all because everything's maxed out from the get-go for people that come to us saying, I want a whole life insurance policy for cash value. So that's how we do it. The thing to look out for, just know that agents are incentivized to sell companies and products with low cash value. If you look for that 80 to 90% cash value in the first year, and you look at one of the 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, you will find that they do tend to pay the lowest commissions on whole life insurance products. Good information to be aware of. Number 4, people don't qualify the agent or group that they are working with. A lot of times they meet with someone, the person seems competent, everything is great. They move forward on the policy and then find out after the fact they were sold a bad deal. This happens a lot. Last month, we were at a conference, met this very, very nice woman. She is a cardiologist, and she came up after we gave her a presentation and she said, Hey, thanks so much for going through the numbers. I was shown this cash value life insurance product. She was putting in $100,000 per year for the first couple of years, and then eventually the plan was to increase the payment to $200,000 per year. The first year cash value was zero. She didn't understand what she was getting. Now, she was proposed this by a family office. A family office, if you're not familiar with that term, it is a group that is made up of highly competent advisors, attorneys, CPAs, financial advisors, insurance professionals. It is meant to consist of the best of the best. But what happened? She was shown a policy with nothing up front. It's like, okay, that was set up for maximum commission, so now this agency can make a ton of revenue on this sale with someone that doesn't know what's going on. She didn't qualify the agent. Another example, recently, someone brought a policy that was already sold to someone, young guy, doing extremely well in business. He was paying almost $8 million per year. The precise number was about $7.6 million. That was his premium. His first year cash value, $2.8 million. That's almost a $5 million loss. And it would take him between 7 to 8 years to get his money back. The agent commission was about $2.6 million in the first year alone. That's what I would have made with that exact product. A year and a half in, this individual starts to look into his policy further and starts to question it. Like, what's going on here? Is there anything I can do? I don't know if I'm going to keep on paying this huge premium every year. It's kind of a lot. With the way it was set up, he's kind of handcuffed to it. If it was set up differently, instead of $2.8 million in first year cash value, he could have had closer to $7 million in first year cash value. He could have easily stopped paying after just 2 years and still see a positive return. But the agent commission would have only been $285,000. Only $285,000. It's a huge amount. But compared to $2.6 million, yeah, that's where point 3 comes back into play as far as what agents are incentivized to sell. So point number 4, just qualify the agent that you are working with. And you can do this very easily by asking your friends, family members, other people you trust with finance to look at the numbers. If someone tells you stay away from whole life insurance, be like, no, I just want to understand the cash value and how it works. Because there's some truth to staying away from whole life insurance if you look at point 1, but if you do it right, it's a fantastic tool. It's just qualifying the agent. Talk to people that you know. You can talk to other agents. If you run into a case where they badmouth the competition, I probably wouldn't work with them because that tells me just a lot about someone's character. Like, that stuff shouldn't be going on. Anyway, talk to other agents. You can talk to attorneys, other professionals, just to get an unbiased opinion on that life insurance product. This way, you can understand it fully before you dedicate money here. Because when people don't qualify this, that's where they have buyer's remorse. Point number 5, all life insurance companies are the same. I've heard this so many times. I've heard it from good friends of mine that have been in the business for years. And what I have found is that it's not true. When we look at whole life insurance policies that have lived the test of time, what I have seen, not on illustrations, but based on real numbers, is that whole life insurance policies with the 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, that are designed in a manner where I have between 80 and 90% of my payment available in the first year cash value and break even between 3 to 5 years. When those steps are followed, 4 major mutuals and designed for minimum commission, maximum cash value, those specific designs I've seen deliver the highest actual returns on cash values for policyholders. And that's based on policies we've written and tracked the performance of, based on older policies that people started before I even got into the industry and they've shared with me, and data that we've looked at from those insurance companies. I've consistently seen it from them, where I've not seen it from other life insurance companies. So a big reason why I like the 4 major mutual companies is because I have seen that consistent proof of performance. and I don't have to hope that it's going to work out for a client. Overpromise and underdeliver. It's a great way to get people upset, especially when you're dealing with their money. Point number 6, the best numbers on paper don't mean the best numbers in reality. What happens so much with whole life insurance is people look at an illustration. The agent points at the long-term numbers, 20, 30 years down the road. You're going to have $1 million if you just follow this schedule. And then when that time hits, the person ends up with $600,000, which is 40% less than what that illustration showed them. I remember years ago, I was speaking with someone who had a policy for more than 10 years. And he said, whenever I get shown these illustrations from my agent, it shows that I'm going to have like $2 or $3 million down the road. But then when I look at the actual numbers, it ends up being closer to the guaranteed side of the illustration, which is less than half. It's like, what's going on here? It doesn't make sense to me. That policy was set up not in his best interest. That's why it didn't look good. The thing is, whenever we see an illustration, common sense would tell me to go with the policy that shows the best looking numbers long term. However, I won't do that, not just based on what company shows the best looking numbers. The reason why is based on my experience. I know what life insurance companies and designs have a track record of producing the strongest actual returns on cash value. And when I see other companies that look good on paper, the question I always ask the company is, do you have any proof? I need to see something before I recommend this to our clients. I have to see it. I need the proof so I can show that policy in good conscience. That's just how I feel about it. So that's always our process when doing due diligence with different life insurance companies. Because again, people come to us interested in whole life insurance specifically for the cash value. How do I maximize it? And then they want coaching on how they can use it. Now, another thing to look out for here when getting a whole life insurance policy for the cash value. Focus on the long term and then ignore the numbers up front. I see this so much and it drives me nuts, where people are told, just think long term, as if they should just ignore the upfront hit they're taking on the money. I usually see 0.7 hit on when someone is being sold a policy that looks like 0.1 or 2 without that cash value there. It's like, hey, that doesn't make sense. Yes, we should focus on the long term. There is a ton of wisdom in that, and I fully agree with it. But what I disagree with is to just focus on the long term and take a hit up front as a result. It's like you can have both. And if you want proof of that, look at what corporations do when they get cash value life insurance products on their executives. The cash value is an asset on the balance sheet. It is maximized up front, and you better bet that they are laser focused on the long-term performance as well. I know that because I used to work at a company where my job was designing policies for corporations before I started my own company and learned all the ins and outs of business and such. The next thing to look out for, look for the guaranteed values. If you are not shown the guaranteed values or you can't get them when you ask for them, that's a sign that something could be wrong. A lot of times this is brushed over saying, hey, this will never happen, it's not important. Granted, most policies deliver values better than what we see on the guaranteed side of an illustration. It is still very beneficial to see. Also, what you can see with this is when a policy is set up with that 80 to 90% cash value up front, you see that in the guarantees, that's a very, very good sign that the policy is set up in your best interest. The next thing to look out for, earn a dividend of 6% and borrow at 5%. You've got this positive arbitrage. So many people fall into this trap. Here's how it's a trap. A dividend rate of 6%. If you see this and you have a cash value balance of $100,000, what do you think your cash value is going to grow by that year? $6,000, 6% of $100,000. Not the case. Anytime we see a dividend interest rate or a guaranteed interest rate on a life insurance product, it is important to be aware that that is a gross rate applied to our policy after the life insurance expenses. It is not our net return, whereas the loan interest rate is what we're paying in loan interest when we have a loan outstanding. So that is a net rate. So whenever we are looking at the percentages, what is beneficial to look at is your annual rate of return or your annual yield, meaning after all of the insurance expenses, what is the net rate of return on a year-to-year basis? What I really like to look at here are the figures in dollars. This way I can see what is the total interest I was paid from the insurance company, and then if I have a loan outstanding, what was the total interest I paid to them, and am I positive or negative? I like looking at that because it helps prevent me from getting in a situation where I have a loss. And the 10th thing to look out for, this is really a question to ask your agent. What if life happens and I can't pay my premium? So important to ask this question. I've seen it happen to people that put in $10K per year, several $100,000 per year. Life happens. If the policy is set up where you lose 100% of your money up front, or you lose 50% of your money up front, and life happens 2, 3, or 4 years into the policy, you could be in trouble where you've got this big premium, call it this big expense associated with the policy. And if you can't pay early on, the policy has to pay the premium by itself. And it's going to do that through the dividends and interest or by taking a policy loan, which will slow down the growth or the performance of the policy. Whereas if a policy is set up with a low premium, a very low insurance expense, and life happens, the policy will compound at a very attractive rate. So it speaks to the importance of one, seeing this up front. What happens if I can't pay after 1 or 2 years? Like not even the premium. I should be fine, but show me the what if scenario. If it implodes because the policy can't handle it, that means my premium's too high. If it keeps growing, that means my premium is very low. The cash value is going to continue to appreciate, and I'm happy. So asking this question can let you see those numbers up front and prevent yourself from falling into a trap. So those are 10 things I would look out for when buying a whole life insurance policy. I hope this video was helpful. If you have any questions, comments, please leave them in the comments below. If you'd like to connect, you can visit our website, ibcglobalinc.com. You can also DM me on LinkedIn. I'll talk to you soon. Thanks so much.